Hi, I'm Janna Fertsman with Remax Nova. I'm here today with Igor Geshelin with Premier Mortgages. Igor and I will be discussing mortgage pre-approvals, what's involved in getting a mortgage in Canada. Igor, welcome.
Thank you for having me, Janna. Happy to be here today.
Igor, how does the mortgage pre-approval begins? What's involved? Where do you start?
Well, a mortgage pre-approval is the first step in understanding your options for buying a home. You have to start with the money. So a pre-approval helps you understand your budget. And to start a pre-approval, you would need to contact someone who can help you with that, which would be a mortgage professional, whether it's a bank or a mortgage broker. That would be the first step in contacting someone to understand what your options can be.
What are the main factors banks are looking when deciding where a mortgage pre-approval starts?
Well, it's a great question. I think it's important to first understand what is a pre-approval. A pre-approval is a review of someone's ability to get a mortgage in general and a calculation of how much. That's what a pre-approval is, and it has to be confirmed with actual documents rather than just words. So it's a validated confirmation of what someone's options are. There are three main factors that determine a pre-approval: someone's income and employment, a down payment, and someone's credit history and monthly payments or debts or obligations they may have. Those are the three key things that make up a pre-approval.
Why is it important for the buyer to get a mortgage pre-approval?
A pre-approval is crucial in making sure that a buyer understands their options and a budget that they can comfortably shop in, and just in general, again, their actual ability to buy a home. There's no sense in looking at properties and homes that you get excited about and fall in love with, only to later find out you actually can't buy them because you are not able to obtain a mortgage for that amount. So a pre-approval helps you understand what you can actually do and then shop with confidence for that price range.
Igor, when you're meeting with buyers, are you discussing other expenses once the buyer buys the property, besides the mortgage payments? What other payments are
Absolutely.
involved?
That's an important one. A lot of the time people think, oh, my rent payment is this much per month, my
Yes.
mortgage payment is the same, so it'll all be the same. I actually think that's a marketing idea in our industry that I don't love, which is, oh, your rent is $2,000 a month, your mortgage will be $2,000 a month, you should just buy, it'll be the same. And I don't love it because it's not true. It's realistically not true. There are also property taxes,
Yes.
which someone would not have when they rent. There would be home insurance, which is more expensive than tenant insurance.
Yes.
And then there would be utilities, which some people are not used to paying if their rent includes it. And in general, utilities for a home would be more expensive than an apartment since the home is bigger. So taxes, insurance, utilities, those things can easily be $1,000 a month or more. So it's not just rent and mortgage payment are maybe similar. You do have to be realistic about the other costs.
Yes. So, Igor, would you recommend someone to buy a home, and why would you recommend them to buy a home, even if it's more expensive to live in your own home? Probably it would add about 30% of more
It could.
expenses than your rent. And is it a long-term or a short-term benefits of buying a home?
I would say it's medium to long term. If you bought a home and then sold it a year later, you could very well lose money.
Yes.
Unless the market happened to luckily go up really significantly, but you can't count on that.
Yes.
With rent, you are paying for the ability to live somewhere. You are not getting anything in the long term out of it.
Yes.
You, after renting for 10 years, you have nothing that is yours.
Yes.
But maybe you lived in an area that you otherwise could not purchase a home in, so that's a valuable benefit of renting.
Yes.
But with purchasing a home, you pay down the principal, which is the actual balance of the mortgage, which is your money coming back to you, and you have a home that is hopefully going up in value. So over time, your home goes up in value, your mortgage gets paid down, and you build what's called equity, which is the portion of the home that you own, and that is something for your future.
About equity, you just mentioned equity. What can people do with equity? For instance,
Absolutely.
say you live in a house for 5 years, and you've paid off some portion of the mortgage, and what can you do with equity?
Well, so with equity, you can tap into it or use it for different purposes. People use equity for different things. They can borrow against the equity in their home, which does mean increasing your mortgage. So it's not, it's not free money. You are
Yes.
applying to increase the mortgage you already have and borrow against the equity in your home. But it can be used for useful things like renovations is a common use,
Yes.
which then further increases the value of the home. Sometimes, if people have other debts that are at higher interest rates, mortgage rates are always the lowest borrowing cost
Yes.
because there's security of the home behind the loan. So, borrowing against the home to pay off other debt in some cases can be a good strategy. Or for someone who's interested in investing in real estate, borrowing against your personal home to then access some money for a down payment on another property is also a common strategy if that's someone's goal.
And probably it all depends how much initially people put in, 5%. So maybe you can talk about mortgage down payments.
For sure. And the difference with buying a home and then later refinancing a home, which is where you can tap into equity, is that when you buy a home, you can, in some cases, put down as little as 5%,
Yes.
which means that you have then financed 95% of the home's value. When you refinance a property, you can only borrow up to 80% of its value.
Right.
So in order for a refinance to be possible, some time does have to go by, especially if initially only a 5 or 10% down payment was made,
Yes.
so that the mortgage is paid down enough and the house increases in value enough for there to actually be some equity to access.
Yes.
For example, if a house is worth 500,000 and someone's mortgage is 380,000, 80% of 500,000 is 400,000. It's only the difference between that 400 and the 380, which in this example is 20,000,
Yes.
that they could access on a refinance. So just because a home has a lot of equity, you can't actually access all of it. So it is usually sort of a later strategy for somebody to refinance, but it can be a good tool.
Yes. Igor, sometimes I talk to buyers and they say, oh, we have right now 10% down payment. We don't want to pay the mortgage insurance. And maybe you can talk a little bit about the mortgage insurance. We're waiting to save 20%, so we don't pay mortgage insurance. Would you talk a little bit about that?
Of course. So when someone buys a home with a down payment that is less than 20%, there's an additional insurance that has to be paid on the mortgage. It's called default insurance. And it's not cheap. So putting 20% down avoids this cost, which is a fairly significant savings. So people often are motivated to try to achieve that. However, it depends on how close you are.
Yes.
So if you're at 18% and you just need to save a little longer to get to 20%, well, I think that's a good goal. But if you're at 10%, saving up another 10% of an average home price today, it's a lot of money. So it takes time. And the question is, could you have bought now? And yes, you would have to pay the insurance.
Yes.
But if you're talking another year, 2 years of savings to get to 20%, how much more rent are you then paying needlessly during that time?
And the home prices.
Right, how much more is that exact same house 2 years from now?
Yes.
So it's possible that if it takes you a long time to get to 20%, the cost you incur while you wait, if you didn't actually need to wait, might erase the savings that you later achieve by avoiding the insurance.
Yes. I think the more people know all the information about, how much they can put in as low as 5% down payment, and also about the mortgage default insurance. If the more information people know from professionals, I would recommend always pick up the phone or text Igor or myself and talk to a professional. don't try to answer those questions yourself or ask your friends.
I agree that that someone should always consult with a professional who's currently involved in the market. People often love to give advice to anyone who's looking at buying a home, and it's well-meaning, it's well-intentioned, but it's based on that person's personal experience that they don't frequently often buy a home. Usually people don't do this all the time. And so if someone says, "Oh, well, I did this when I bought my house, so you should too. And I did it, 5 years ago, and this is what I did." Again, they mean well and they want to help, and that choice that person made was hopefully the right choice for them at that time. But this is a cliche thing to say, but there's no one right thing for everybody at all times.
Yes.
So just because I might do something or you might do something or anyone does any one thing doesn't mean that that's the best choice for that next person. So consulting with a professional who can actually review your situation and ideally give you good advice is beneficial or should be beneficial.
Igor, sometimes people have not very high mortgage pre-approval. For instance, maybe 400,000. It's difficult to find a nice home in that price range in HRM. Right now, I had some people that looking outside the city, even Windsor, not far from Halifax. Also, some people decide to look at condos because generally condos, it's a like apartment style home. It's a little bit less expensive. Would you recommend people? What do you say to people about purchasing their first home?
As far as a lower price point or a more
Yes.
difficult price point, there's always a solution, but it comes with a compromise. So the things you mentioned, looking outside of the city in maybe a smaller town, Windsor, Truro, South Shore, some of those areas have become more expensive too, but still they're certainly cheaper than Halifax.
Yes.
And that may be the compromise. Type of property. So, I'm sure everyone would love a detached home, but the reality is they're more expensive than they used to be.
Yes.
And so looking at, a townhouse or a semi-detached or a condo. With a condo, you have to be conscious of the condo fee.
Yes.
So the purchase price is lower, the mortgage payment will be lower, but the condo fee might actually not make it that much cheaper in the end, depending on the fee, the building, what the fee includes.
Yes.
So that's where, again, consulting with a professional who can help understand that for you for each building is important. Another strategy that can help increase the budget, which is not for everybody, but looking at a property that has a rental unit and not like a little basement that maybe you could convert to rent out a bedroom, but an actual legal rental unit, whether it's a basement apartment or something like this. If it's a properly legally zoned unit, banks will account for the rental income from that second unit in their calculation of a pre-approval, which then helps increase the pre-approval limit. So again, not everybody wants to be a landlord or have that type of property,
Yes.
but for some, it can be a good approach that helps them increase their pre-approval limit.
Thank you so much, Igor. It was a pleasure talking with you today.
Thanks for having me.
Thank you.